Hello and welcome. You're watching Informed Investor, brought to you in association with the National Stock Exchange. I'm Sumaira Abdi. Informed Investor has had a very exciting journey so far, and through the course of this series, we've interacted with a whole host of communities, from lawyers to doctors, professors and students to IPS officers. We've also met with women from all walks of life, and we've brought these retail investors face to face with some of the best and brightest financial minds in the industry who've advised them on a whole host of issues.
What is the right time to invest in the equity market?
Are there ways where you can plan with meager resources right from now for education of children?
What is your view against other investments vis-a-vis investing in art?
Basically, I would like to know about the retirement benefit plans.
All right, so that's what our journey has been like, and through this we've been flooded by queries from investors across the country. So we thought it would be a good idea to take a small break from all the traveling and reach out to those investors we are unable to meet in the normal course of our interaction. So today we'll be taking up all the questions and comments that our viewers have been sending in to us through the last few weeks. And in our Mumbai studios today, we have Mr. S.P. Tulsian and Harshvardhan Roongta. But before we begin, I have a few questions also for our experts. Mr. Tulsian, I want to ask you first that, off late we're seeing that some amount of positive momentum is building up as regards the news flow that's coming in. Is this a good time then for retail investors to start being brave?
See, I don't think, Sumaira, you can really take a secular call, because obviously the news flows are very good, especially from Europe. And again, we are expecting some, policy initiative from our country as well. So as long as these news flows keeps coming in fact, I have been maintaining this probably for last 6 months, when we have seen this calendar year having started, that, look to book a profit of anywhere between 5 to 7% over a period of 1 to 2 months. I don't think that there is any point in trading too much in the market, because people generally go overboard when they see any positive indications coming in. But generally we have seen that traders, they land up at a higher price, then you see the stop losses getting triggered, they ultimately incur into the losses. So be a short-term investor. Keep taking a time horizon on each investment which you make, whether you take a time horizon of 1 week or 1 month. And if you have that approach, if you stick to the quality stocks, and that is what in fact whole of 2012 has seen us, or has made us to make money only from the quality stocks. I don't think that you can really play on the ideas. Whether you are catching the theme or whether you are catching the stock doesn't matter, but stick to the quality. We have seen that happening in IT, we have seen that happening in cement, pharma, or maybe the other frontline stocks like the houses. Maybe the Tatas have given good returns, Bajaj stocks have given good returns. So if you are into the quality, if you have a time horizon, and if you are a short-term investor, I think this market will keep on giving you a return of 3 to 5%, 5 to 7% over time horizon. No point in taking a long-term call that I wish to make investments for a period of 2 to 5 years. This is not the time, and I think the market is likely to behave in the same manner for next 12 months or so.
All right, so one part is making money, but the other part, Harshvardhan, that I want to ask you about is safeguarding the money that you have, or perhaps the plans that you've made for the future. And in a lot of cases where people take life insurance, but that's payable only on death, what do people do in terms of disability? I know this is not a question that a lot of people have asked on our show, but surely this is something that would be of help to our viewers.
There are plans which basically take care of you financially in case you're disabled due to an accident or due to a critical illness, due to some form of an illness. Now what happens in these cases is that, suppose if a person has taken an accident cover of say 1 crore of rupees, for which the total cost per annum is about 12,000 rupees. So it's about 1,000 rupees a month. I would say just about or lesser than what a multiplex visit would be for a family per month. Now what happens in case of a death because of accident, entire 1 crore is paid out. In case of an accident not leading to death but has rendered a person completely disabled, he gets 1 crore in his own hand, which he can use to protect his own self, deposit that money in a fixed deposit, get an interest out of it, and have his own living out of it. The same concept applies for life insurance. How do you plan life insurance? You buy an insurance and then you basically with an intention to protect your loved ones. In this case, you do it for your own self. Similarly, there are other benefits which just scale down a little bit. If a person is partially disabled, he gets half the sum insured that he has taken. And if he's temporarily disabled, just knocked down and he's bedridden, no permanent disability, but he's absolutely bedridden for about a couple of months. That period is also taken care of in the form of a fixed payout every week.
And I suppose that also for a policy like this, a standalone policy would make more sense than clubbing it with a life insurance policy. But do remember, viewers, that financial planning and personal finance, the scope of it extends a lot more than just your portfolio allocation. And you can also ask us questions about all aspects of your planning. But let's get to our first question. It comes in from Mumbai's Praveen Tayal. He writes to us via email and wants to know if valuations for large and mid-cap stocks are attractive currently, and what's a good entry point. Mr. Tulsian, that's a question that's right up your alley.
See, one cannot really take a general call. Now, suppose take for instance, if you are talking of the large cap stock, suppose if I need to take a call on the cement sector, probably you will find ACC as reasonably valued, while you may find Ambuja Cement as little expensive. Though both the companies have the same capacity, same promoters and all that. Similar is the case in the mid cap. In fact, mid cap, there is a lot of variations. Suppose, for example, if I say that P multiple of 5 is given for one stock, probably you will find again in the same space, same sector, multiple being given in double digits. So it has to be the stock specific, depends on the profitability, depends on the financial performance, depends on the promoter, depends on the other their speciality. Maybe they have the larger cash balance or they have the debt and all that. So there is no general rule where one can say that the mid cap and large caps are reasonably valued now or not.
All right, so I suppose a stock-specific approach is what would work best. But our second question is right up Harshvardhan's alley. Vishwanath writes in from Bangalore. He wants to know about gold ETFs and if now is a good time to start investing in gold. In fact, gold ETFs is also a very common theme with our viewers. And another viewer has written in to us. He wants to know if SBI Gold Fund is a good option also.
Gold ETF, yes, it's a very, very good form of owning gold. It is more transparent in terms of pricing. It is more tax efficient. You do not have the burden of storing it or the costs associated with storing physical gold. Gold fund of fund is just one layer behind, and it's going to be naturally a little more expensive because you have another layering to it. SBI Gold Fund, yes, a good fund to invest into.
Okay, any other recommendations that you want to make on gold ETFs or gold funds?
Well, it's the same. I mean, the underlying asset is gold. They are investing into the gold ETFs of the same fund house. You just need to be careful about the expense ratios, which SBI is fine. I mean, typically the expense ratio is about 1.5% in a gold fund, 0.5 of the ETF and 1% of the fund. So SBI Gold Fund is good.
All right. So on that note, let's take a very quick break. We'll come back in just a bit. Do keep watching Informed Investor.
Note 800.
Welcome back. You're watching Informed Investor. You're probably surprised to see us in our studios this weekend and not crisscrossing across the country. Well, this is a very special episode where we're answering viewer queries with Mr. Tulsian and Harshvardhan. Well, I believe we have a caller now who joins in to ask his question. Rajkumar Daga calls in from Kolkata. Go ahead, Raj. What's your question?
Good afternoon.
Hi, go
Hello.
ahead. What's your question?
My question is, who drives the stock market?
All right.
What makes it go up and down?
Okay. So you want to know how, what causes the movement in the stock markets and also what causes the volatility therefore?
See, if I say that judiciously or maybe by the right method, it is the financial performance and the promoter's background. These two things really drives the market. I am not including the operator activity. I am not including the market makers and all that, which sometimes we do find that happening more into the maybe the mid cap and small cap stocks. So if you really want to say that what is the driving force for any stocks to move up or down is the financial performance, fundamentals and the promoter background.
And that's clearly something, Raj, that you'd want to keep on your radar the next time you want to go about investing. But thanks so much for calling. I hope that answers your question. Also, Kaushal Mehta is our next viewer who writes in on our Facebook page. He writes in about the drop in retail participation in the markets, and his assessment is that perhaps transaction costs are too high. Harshvardhan, for someone who has this fear of transaction costs being too high, any other options that they have besides maybe equities or mutual funds?
Sumera, if one needs to operate and invest into India, you need to go by what is available in India. So answering the question, very little is what can investor can do if he wishes to invest into already listed equities. Yes, the regulators are working towards this to reduce costs of transaction, but given by what it is today, you will have to probably take what is available.
Yeah, I mean, everything comes at a price. All right, but time to get stock specific now. Narendra Kane writes in from Vadodara. He's a long-term investor, and he, I believe, had purchased shares in NHPC, SCI and BHEL during their IPOs, but is currently sitting on a bit of losses. So, Mr. Tulsian, what's the call on his stocks? Is it time for him perhaps to bite the bullet, or does he hold on?
No, I think he should exit from NHPC. Firstly, because if you see the performance has been very stagnant, there has been no capacity addition. They are into the hydropower, and as such, overall the power sector is not the favorite of the market. So he should exit from NHPC. Second is the Shipping Corporation of India. Again, the horrible performance. Just now we have discussed the financial performance, which drives the share. This company has posted losses in first quarter. Obviously, the hopes are not very good from the company in the remaining 3 quarters as well. So even there, I'll advise him to exit. And as such, if you take the overall fancy or the liking for the public sector unit stocks, I think it's very minimal. It's very low. So he should exit from Shipping Corporation also. Coming specifically on BHEL, though there has been very negative news flows coming in respect to the order cancellation to the extent of anywhere between 35,000 to 50,000 crore and the concerns on the profitability. But I am holding my positive view for the simple reason the company posted an EPS of 29 rupees for FY12. Even if you take the worst case scenario, I don't think that EPS is going to fall below 24 for FY13. No point in taking a earning call for FY14 unless until we have the clarity on the order inflow. And if you take the case of capital goods sector, they have always been ruling very high. I am not talking of the period now in which we are going through, where BHEL is ruling at a single digit, maybe a P multiple of 7 on the historic earning. So I find good value in the share of BHEL, provided he keeps a view of 1 year or so. So remain invested in BHEL, exit from other two.
All right, so bite the bullet on NHPC and Shipping Corporation, but BHEL is something that you could hold on to. Next up is Sudeep Bunia. He writes in from Kharagpur, and he says that his friend would like to gift him some shares, but he says that they don't belong to the same broking house. I suppose what he means, what he's referring to as separate demat accounts. He wants to know now how he can go about this transfer of shares.
No, it's very simple. Even if it is not with the same broking house, but suppose if it is with the same DP, he can, make the transfer in the off-market section. There is always a column in the demat slip, and he has to fill in the off-market slip. Suppose if the donee to whom he wants to donate or give the shares, if the DP is different, there are two DPs, NSDL and CDSL. So in that case, he has to fill in the inter-depository slip. It's very simple process. Only the respective column, either of the inter-depository slip or of the same depository in the off-market section has to be filled in. It's very simple.
All right, so we've been answering a whole host of questions in this particular episode, but we'll take a very quick break, be back in a bit. On the other side, we'll tell you what an ideal portfolio should consist of. Stay with us. Welcome back. You're watching Informed Investor, where we're answering viewer queries this week, and with us are Mr. S.P. Tulsian and Harshvardhan Roongta. All right, we have another caller on the line with us. Krishna M. Raju calls in from Amravati. He says he's holding HDIL shares. Go ahead, Krishna. What's your query?
Good evening, sir.
Hi, good evening, Krishna. What's the question on HDIL?
Madam, this is Krishna Raju from Amravati. Present, I work in SKS Microfinance, madam. Just I want to know future prospects of HDIL and IVRCL, and it is the right time for enter HDIL in current level. And I want to hold Switzerland and Vikas Metal and Power.
All right, let's take your stocks one at a time. You're currently holding HDIL. What was your acquisition price, and how many shares are you holding?
95, madam. I have 2,000 shares.
All right, Mr. Tulsian, 95 is what he bought it at.
See, Raju, I'll advise you to hold into HDIL for the simple that the company has the largest TDR holding in Mumbai city. You can call them as the largest real estate developer in Mumbai. And if you see their financial results for first quarter, in fact, that has been quite good. They have started reducing the debt portion of their in their books also, which stands at about 4,200 crore. And in fact, the best part about Q1 results is that the company has not sold a single square feet of TDR, which is likely to start from the third quarter of this financial year. So once that happens, the company has indicated that they will be reducing the debt by about 1,000 crore in this financial year, which itself is a very good. In fact, if you compare on any other real estate companies, take the case of DLF or maybe the case of Unitech, they have not been able to reduce their assets by monetizing the assets, while in case of HDIL, they have the advantage of selling the TDR because they are the largest real estate developer or the redevelopment projects, which they are undertaking, like the Santa Cruz Airport land also is being developed by them. Apart from that, they will be completing 4 of their projects in this financial year or maybe in next 12 months. So partly it will get booked in this financial year, partly in next financial year. So remain invested into the stock, and I have a very positive view. Probably you should be able to see your share price maybe in next 6 months, and can expect to see 20-30% profit on your cost in next 12 months or so.
All right. And also, I believe you have a query on IVRCL. So take us through the details of how many shares you're holding and what you bought them at.
Madam, my brought-in price is 55 rupees, madam, and I have 10,000 shares.
All right, 10,000 shares at 55.
Raju, again for IVRCL also, I will advise you to remain invested. If you recall, the hostile takeover process was initiated by SL Group, and in fact they have given a pause, and probably if that starts again, you could see the price moving back. Depends on the acquisitions, how fast they acquire it, whether they trigger the open offer, and in that case price can again move back to 60-65. But let's not play on that theme. Straightway come on the financial working. Company or the management issued a very positive statement. They have said that they will not be venturing into the road projects from here on, which has been seen as a drag on the company's working capital because the huge amount gets blocked in the road projects. So now on they will not be pursuing the road projects, number one. Number two, they are looking to monetize many of their BOT projects, like they have Chennai desalination plants or many other projects even in the road portfolio. So if all those things happens, and if they are able to curtail their debts by about 750 to 1,000 crore, I think, which is possible in my view in next 6 months or so. So the stock has a bright future prospects, and my advice is to remain invested.
All right, so both your stocks, HDIL and IVRCL, Mr. Tulsin's given a time horizon of between 6 to 12 months. So a good idea then to perhaps hold on to that. But thanks so much for calling in. Also, that's not all. A lot of our viewers have also been posting their portfolios on our website, moneycontrol.com. So we asked Harshvardhan to select a portfolio that was in the most dire need of repairs and also take us through how it should be rectified. Go ahead.
Well, we've taken the case of one Mr. Sunil Rathore. He's in his 40s. He has about 4 goals. The first one being that he needs to just accumulate some corpus in the form of capital appreciation with a further for a further 20 years from now. He wants to get his daughters married after 20 years from now. Education in MBBS for both daughters age 4 and 2 years from now. And he has a housing loan of about 25 lakhs, which he wishes to repay in 15 years with an EMI of 25,000 per month. Now, Sunil, when I take a general observation onto your portfolio, what I need to just highlight to you is that you also need to quantify your goals. So I would suggest that you do that keeping inflation in mind. In your existing portfolio, you have about 50% into direct equities. So I'm assuming you understand the investments and the risk associated with direct investments into equities. So I would suggest map this particular asset class for retirement, because it's long term in nature. You do have control. You do not need to withdraw everything at retirement at one shot. So equities, direct equities, you can map it for retirement. The other goal that you have is for daughters' marriage and education. Now you could balance this part of the goal by investing into mutual funds. Your existing mutual funds, along with the fresh investments that you want to make, should go into, say, probably in a form of a systematic investment plan in 2 funds I will give you. One is an actively managed fund, one is a passively managed fund. You can choose an HDFC Children's Gift Fund investment plan, which is a 75% equity portfolio and 25% into debt. The other I'm suggesting is an index fund, a passively managed fund. Probably I would say the lowest cost of entering into equity. We've discussed that it is expensive to buy equity. So probably the lowest cost that you can incur to enter into equities would be through an index fund. You can choose to invest into the Franklin India Index Fund, the BSE Sensex plan. It's a passively managed fund it replicates exactly what the Sensex is going to, the stock composition in the Sensex. As regards to your home loan, you have an outstanding of about 25 lakhs and you wish to make a payment of 25,000 per month so that your loan is repaid in 15 years. Considering that the current interest rates on home loans is about 10.5%, you would need to extend your tenure from 15 years to 20 years so that the same EMI can pay off your housing loan. Also considering that you have other goals which are again 20 years from now, I don't think it would be wise to increase your EMI and at a cost of making investments for your objectives and for your goals, which is daughter's marriage and education. So continue and request your bank, maybe the bank may consider your request of extending the loan from 15 years to 20 years from now. This will help you allocate 25,000 for the home loan and also leave some surplus for you to invest into other goals.
All right, fabulous. But that's about all the time we have this weekend on Informed Investor. Thank you so much, Mr. Tulsi, and thanks so much, Harshvardhan, for joining us. And it's always a pleasure to have you over. But do remember, viewers, you can keep sending us your questions and comments. We will try and answer as many as we can in the coming episodes. Also, next week we start touring corporate campuses across the country. So do remember to tune in to Informed Investor next weekend. Bye bye for now. Thanks for watching.